All right, so markets were feeling pretty good, right? Everyone was betting that interest rate cuts were just around the corner, and then bam, everything just hit a wall. In this explainer, we're going to break down exactly what went down, why it happened, and what it really signals for the economy.
So, you gotta ask, why the sudden shift? What spooked everyone from being so optimistic to so anxious? Well, it all boils down to one crucial decision and one surprising number. Let's get right into it.
Okay, first up, let's talk about the main event. This all kicked off at the latest meeting of the US Federal Reserve. They made a call that, believe me, sent a chain reaction through the entire financial world.
You know, the funny thing is, the big news wasn't something they did, it was what they didn't do. The Fed decided to just hit pause. They left interest rates right where they were. And that was a huge signal to the market, basically saying, hey, pump the brakes. This inflation fight isn't over. And where exactly are they holding? We're talking a range of 5.25% to 5.5%. Now, that's not just some random number. That's a pretty high level, and it's designed to do one thing: keep borrowing money expensive to try and cool the economy down.
So what happened the second they announced this? Well, it was like a shockwave. Markets had already convinced themselves that good news was coming, so this pause just completely upended everything.
And one of the first places we saw the reaction was in the bond market, the yield on the 10-year US Treasury. And you got to pay attention to this one. It affects everything from mortgages to business loans. It shot up past 4.5%. That's the market's way of screaming, get ready, borrowing costs are going to stay high.
And this wasn't just a US story. Look at this. When US interest rates are high, that's really attractive for investors around the world. So what do? They rush to buy up US assets. All that money flowing in makes the US dollar much stronger compared to other currencies.
And the stock market? Whoa. It was like a bucket of ice water right to the face. All those nice gains people made at the start of the year, gone. And the companies that got hit the hardest were the ones that need to borrow a lot of money to grow. You know, like tech and real estate. Investors just started dumping those stocks, realizing the era of cheap cash was on hold.
Okay, so why? Why did the Fed hit pause, and why did the markets freak out? Well, the whole story comes back to a piece of economic data that dropped right before the Fed's meeting. And let me tell you, it was a bombshell. This right here, this is the heart of the whole issue. Everybody, and I mean everybody, was expecting inflation to keep cooling off, just a nice, steady decline. But what actually happened? Nope. Inflation came in hot, way hotter than anyone predicted.
And here it is, the number that threw a wrench in the works. 3.4%. That was the jump in consumer prices for January compared to the year before. And the really bad part? It wasn't just higher than expected, it was actually up from the month before, not the direction you want to see.
Now, the Fed is smart. They don't just look at that one big number. They focus on something called core inflation. Basically, they take out the stuff that jumps around a lot like food and gas prices to see what the real underlying trend is. And that trend was basically a big flashing yellow light.
So why is inflation being so stubborn? The term you'll hear is sticky. And as you can see here, it's because prices for services are still really high. Think about it. Rent and housing costs, they're not really budging. And the costs related to what people earn, wages, they're staying pretty elevated too.
All of this puts the Fed in a really tough spot. It's like they're walking a tightrope. There's a huge risk if they lean one way, and another huge risk if they lean the other way. And we don't even have to guess what they're thinking. They told us. Their official statement was super clear. They said they need greater confidence that inflation is really and truly heading down for good before they'll even think about cutting rates. A couple of good months isn't going to cut it.
And this really lays out their dilemma perfectly. On one hand, if they cut rates too early, they could let inflation come roaring back, and all that painful work would be for nothing. But if they wait too long, they could choke off the economy so much that it triggers a slowdown or even a recession. It is a true balancing act.
All right, so what does this all mean for us, for investors, for businesses? What's the takeaway here moving forward? You're going to hear this phrase a lot now. It's the new mantra on Wall Street, higher for longer. And it means exactly what it sounds like. That dream of super cheap money coming back? Yeah, that's on hold. We should all get used to the idea that interest rates are going to stay up for a while. And this isn't just some abstract financial concept. It has real-world effects. When those Treasury yields are high, it gets harder for everyone to get money. Mortgages for buying a home? They stay expensive. Companies wanting to expand?
it costs them more to borrow. It even puts pressure on other countries as investment money flies back to the US.
So that's where we are. The Fed is playing the long game. They're in a holding pattern, choosing to be patient rather than jumping the gun. And while they wait, everyone else, the markets, businesses, all of us, we just have to adjust. Which leaves us with the big question, right? What's it going to take for the Fed to finally get that greater confidence they keep talking about? And more importantly, what happens to the economy while we all wait to find out?